guys. Let's continue with my talk on asset, debit and credit, double accounting, double entry accounting. So here I finally finished my picture that where you can see that the everything asset is all in red, and then on the left it's all red because they're all increase in asset. So we have a debit, we have expenses. On the right-hand side, the marketing equation, the accounting equation with the blue, the liability and the equity, they are all related to credit. So basically, if you want to summarize the thing that we the two entries, it will be an easy way to remember is that debit is left up, right down. Anything on the left will be up, that's a debit. Anything on the right hand side will be going down, that's a debit. On the other hand, the credit is right up, left down. So that's the opposite. So here we can look at this one because this is the beauty of this one is that there are only three items: asset, liability, and equity. That's all. We only remember that. So we don't have to remember so many different things. We only need to remember three things, and then everything else will be connected to that. Okay. So here on the left, you see that the double line. That double line is the shows that that's the item on the balance sheet. That's asset. Okay. The one expenses below the double line is actually from income statement, or also called the P&L, profit and loss statement. Okay. And then on the right hand side, similar. You have a liability and you have an equity. Those are directly from a balance sheet, but revenues will be from the income statement. So income statement basically it's about two things. One is how much you make, how much stuff you sell, and two is how much you spend on it to make the sale possible. So here you can see that take a quick look on the items. I listed all the major types of major account of the asset. For example, cash and cash equivalent. Cash equivalent, including savings and checking account, that's considered the same as cash. Inventory, everything that you put in a warehouse. Marketable security, that's like CDs, some bonds and notes, easy to sell. That's basically they are very highly fluid. Okay. Prepaid expenses, meaning that you something you have paid but you haven't used it yet. It's like you bought a music, a concert, ticket to the concert. You haven't used that before. You use that, you can still sell it for cash. So that's why it's called the prepaid expenses. And then PPE, property, plant, equipment, those are the hardwares. Intangibles, okay. So on the right-hand side, you see the current liability and the non-current liability. Those are the two categories. And we have different things. The other things like, for example, note payable, loan payable, they are the same thing. They are both loans, just, a different name for that. So those are the things, okay? And then equity, you have retained earnings, you have a stock and an additional paid income. Those are all people, the money that people can put in their pocket at the end of the day. So that nobody can take away from them. So now here on below the double line is revenue. Remember that revenue is from income statement. So this way, in this little single picture, we have the balance sheet, and also we have an income statement. We combine them together. So here it makes sense. I want to make sense of it. It's very easy to remember this. Why do you want to put expenses on the same side as asset? Because the easy way to remember, because they all have something to do with the equity. Owner's equity. Equity, remember, is the owners can put in the pocket. Okay, that's the end of the day, the profit. Okay, so think about this. In order to make a profit, if you spend a lot of money on buying stuff, a lot of the expenses, vehicle expenses, marketing expenses, administrative expenses, the higher these expenses, what will happen to the equity? Well, the more money you spend on expenses, the less equity you will have. That's why, since the expenses will decrease the equity. So that's why, remember, debit is left up, right down. Right hand side is down, so equity is down. So anything decrease the equity, that's why expenses will be considered as a debit. Now the same logic here. Let's consider revenue. Revenue, remember, that's another basically income statement, just two things. One is revenue, another is expenses. So revenue, the more stuff you sell, the more equity you will have, right? The more for example, your item is selling well, like Apple's iPhone, right? The no trouble to sell. So the more iPhone is sell, the more money that the more honored Apple's honors, the equity will be high up. So that's why that's why revenue has to go on the right hand side, the same as credit. Remember, credit is right up, left down. Debit is left up, right down. So revenue, that's how. So that's why you can see that you don't have to remember all the hard ways. You just remember that everything you can link as long as linked with the three items: asset, liability, and equity. Then you'll be set. That's it. Okay. Thank you.